Hi guys, welcome back. This is gonna be the summary of video 3 of the ICT Mentorship 2023. S&P 500 Live Execution and Mean Threshold Risk Management. As always, refer to ICT original content. In this episode, we are gonna see a market review and execution, mean threshold and risk management. Here we are looking at the E-mini S&P 500 futures on the 1-minute time frame for the contract of March 2023. ICT is showing us the trade that he took on the 17th of January 2023. ICT entered the trade where you see the big black arrow on that bearish candle, and he put his stop loss right there where you see the yellow line. ICT indeed entered where the price tapped back into the fair value gap. ICT set his take profit there at 40.36, and he highlighted for us the red line, which is the closing price of December 14th, 2022. So he's telling us that those are the two main levels to think about and to keep an eye on. This last bearish black candle is the beginning of our bullish order block. ICT entered inside a fair value gap, and that fair value gap is actually a getaway fair value gap. Notice that inside that fair value gap, there is an absence of any of the body of the candle. So what we actually see in there are wicks. And we hope that that fair value gap is going to keep staying open. Where you see the yellow line on it, you're gonna see a big black arrow. We had sell-side liquidity there, which got purged at around 9:40 a.m. in the morning. If you look at the red circle, you can see a gap there. That's a volume imbalance that the price just created while running away from the fair value gap. As you can see, guys, from this screenshot, the price is going higher and higher. And ICT is waiting to accumulate more positions, so to enter with more contracts before the price reaches this red line. At the red line, ICT will take the majority of its profits, probably on the 40-30 level, and it's gonna exit. Right now, as ICT entered only one position, his risk for this trade is set at 1.2%. Based on a $100,000 account. The price keeps moving and ICT was teaching us, so he got a little bit distracted. He tells us that he should have entered there on that week, but he actually got distracted, so he didn't. When he got distracted, he was actually showing us in the area in gray to view the price in this amount of ranges, which is indeed 5 handles. So he was showing us how big are 5 handles on this specific chart. So guys, there are a lot of things going on in here, and I'm just gonna zoom in. As the price went higher and then it came back, so it formed 2 bearish candles, ICT decided to enter another position there. When ICT entered that second position, his risk got elevated to 1.3% of his total account. What we want to see is the price moving fast and strong through the buy-side liquidity, which is indeed the level of our morning high. You can see here with 2 red circles and 2 big black arrows, 2 bearish candles that are actually the beginning of 2 bullish order blocks. So let's zoom out and let's go back at where we were before. ICT moves at this point his stop loss at where he actually entered the trade, removing completely the risk from its trade. He tells us that that's because the price is stalling too much, and he actually wanted to ensure that the stop is not taken while the price is consolidating. So remember, we wanted to see speed and distance, and this is not exactly what's happening with the timing with which ICT expects it. Right now, the price did not move with speed over the buy-side liquidity, and that's actually what we wanted to see. And that makes us rethink and reevaluate what the price could be doing next. There is always the possibility that the price wants to go lower and revisits the fair value gap. The price touched the buy side liquidity, and as you can see here, it actually went down and formed a bearish order block. The price kept going lower, and ICT entered more positions going long. He believes that the price should not go below the volume imbalance, so that gap that we have seen before. It can touch the bottom of it even, but it should not pierce it and go lower. So we still expect the price to go higher. And what does the price do? Guys, look at the precision. This is incredible. The price actually touches the higher end of the gap precisely, and then it starts going higher. It is very, very neat. It is very, very precise. Now we are expecting the price to make a new high and do it fast and do it strong and really show some speed. And here it goes. Notice how the price moved a lot, and we had actually several occasions to make at least 5 handles. Here the price pierced forcefully through the buy-side liquidity. ICT tells us that there is a macro that takes place between 9:50 and 10:10 AM New York local time, which usually causes the price to run in the direction in which we would expect it to. The price keeps going higher, and ICT decides to exit its position, making $10,400 in one trade only. So he actually at the end exits at 40.30. And that's about it for this episode, guys. This is the way. Keep going. Do not give up. Hard choices, easy life.